Assalamualaikum warahmatullahi wabarakatuh. Hello guys, my name is Khasanah Putri with student number 19105130002 from Faculty of Economics, Andalas University. In this video, I want to explain about currency crisis. So, let's get started. Okay, I will start the explanations about currency crisis. The first one is, what is currency crisis? A currency crisis is brought one of sharp decline in value of country's currency. This decline in value in turn negatively affect an economy by creating instabilities in exchange rate. Meaning one unit of certain currency no longer buy as much as it used to in another currency. To simplify the matter, we can say that from a historical perspective, crises have developed when investor expectation caused a significant shift in the value of currencies. Um, uh, we can conclude that currency crisis involve the sudden and steep decline in the value of a nation currency, which cause a negative ripple effect through the economy. The second one is, unlikely as currency devaluation as part of trade-off. Currency crisis is not purposeful even, and it have to be avoided. And the last one is, certain central bank and government can intervene to help stabilize a currency by selling off reserve of foreign currency or gold, or by intervening in forex market. Next, what causes currency crisis? Investors often attempt to withdraw their money and mass if there is overall erosion in confidence of an economic stability. This is referred to as capital flight. Once investors sell their domestic currency dominated investment, they convert those investment into foreign currency. Discuss the exchange rate to get even worse, result in a run of on the currency, which can then make it nearly impossible for a country to finance its capital spending. Uh, Currency crisis prediction involve the analysis of diverse and complex set of variables. There are a couple of common factors linking recent crisis. The first one is the currency borrowed heavily, or we can say currency account deficits. And the second one is currency value increased rapidly. And the last one is uncertainty over the government's actions unsettle investor. Next, the currency crisis examples. The first one is Latin American crisis of 1994. On December 20, 1994, the Mexican peso was devalued. The Mexican economy had improved greatly since 1982, when it last experienced uphill fall. And interest rate on Mexican securities were at positive level. Several factors contribute to the subsequent crisis. The first one is economic reform from the late 1980s, which were designed to limit the countries of rampant inflation began to track as economic weakness. The second one is the assassination of Mexican presidential candidate in March of 1984, sparked fear of currency sell-off. The last one is the central bank was sitting on the estimated 28 billion dollar in foreign reserve, which were expected to keep their peso stable. In less than a year, the reserve were gone. When the government finally decided to value the currency in December 1994, it made some major mistake. It did not devalue the currency by a large enough amount, which showed that while still following the pegging policy, it was unwilling to take a necessary painful step. This led foreign investor to push the peso exchange rate drastically lower, which ultimately forced the government to increase the domestic interest rate to near 80%. This took a major toll on country gross domestic product, or GDP, which also fell. So the crisis was finally alleviated by the emergency loan from United States. The second one is ASEAN crisis of 1997. Southeast Asia was home to tiger economy include Singapore, Malaysia, Chinese, and South Korea and Southeast Asian crisis. Foreign investment poured in 4 years. Underdeveloped economies were experienced rapid rate of growth and high level of export. The rapid growth was attributed to capital investment project, but overall productivity did not meet expectation. While the exact cause of crisis is disputed, Thailand was the first to run into the trouble. Much like Mexico, Thailand relied heavily on foreign debt, causing to teeter on the brink of ill liquidity. The risk came to the head when U.S. increased domestic interest rate, which ultimately lowered the amount of foreign investment going into the Southeast Asia economy. Suddenly, the current account deficit become huge problem and the financial contagion quickly developed and the Southeast Asia crisis stem from several key points. The first one is fixed exchange rate become excessively difficult to maintain. Many Southeast Asia currencies dropped in value. The second one is Southeast Asia economies saw a rapid increase in privately held debt, which was bolstered in several countries by overinflated asset value. Therefore, increased as foreign capital inflow dropped off. The last one is foreign investment may have been partially speculative, and investors may not have been paying close enough attention to risk of fraud. Okay. Lesson learned from currency crisis. First is an economy can be initial soft and still succumb in a crisis. Having a low amount of debt in is not enough to keep policy functioning or quell negative investor sentiment. The second one is trade surplus and low inflation rate can diminish the extent at which a crisis impact an economy. But in case of financial contagion, speculation limit option in the short run. The third one is government will often default or provide liquidity to private bank, which can invest in short-term debt that will require near-term payment. If the government also invests in short-term debt, it can run through foreign reserve very quickly. And then the last one is maintaining the fixed exchange rate does not make a central bank policy work simply on face value. While announcing intention to retain the peg and can help, investor will ultimately look at the central bank ability to maintain the policy. The central bank will have devalue in sufficient manner in order to be credible. Okay, we can conclude that currency crisis can come in multiple form, but are larger form when investor sentiment and expectation don't match the economic outlook of a country. While growth in developing countries is generally positive for the global economy, history show us that growth rate that are too rapid can create instability and a hard chain of capital hike and run to the domestic currency. Although efficient central bank management can help predicting the road of an economy ultimately take it difficult in anticipate, thus contributing to sustainable currency crisis. Okay, I think that's all my explanation about this topic. Thank you for your attention and sorry for all of my mistakes. Wassalamualaikum warahmatullahi wabarakatuh.